kick this off, index funds have a reputation for being boring. What do you guys think is the most exciting part of index fund implementation that most index fund investors probably are not aware of?
Yeah, I think it's a couple things. One, just the amount of activity that an index does on a daily basis to maintain the uh, the market weighting is significant. So we process probably over 20,000 corporate actions every given year. A lot of those don't necessarily require action, but they require some type of attention. But every day the index is making some type of change to its composite to better match the market. The second thing would be we actually take risks in our index funds against the benchmarks. Albeit small risks, we're looking for asymmetric risk return opportunities to actually add a little bit of value back to the performance against the benchmarks.
Hmm.
I think, Ben, I'd like to give a shout out here to fixed income, because I think a lot of times when we talk about, indexing or index fund investing, I think everybody just defaults to equities for some reason. And I think what's really interesting in the fixed income space is you've probably heard this claim before that, well, it's different in fixed income, and because funds are sampled, they're not able to track the market well. And it comes from this notion that portfolio managers seemingly like randomly pick individual bonds, and it's not good enough to track the index. But what most investors don't know is that to implement a sampled or an optimized fixed income fund, they don't do bottom-up construction. They do top-down construction. And so there's great thought about matching, you've talked on this program before, systematic risk factors. Number one being you want to buy bonds that you're going to match the average duration of the index itself. And then you're going to figure out ways to match risks at duration along the curve. Like, do you have the right proportion of 2-year bonds, 10-year bonds, 30-year bonds, etc.? You want to make sure you have the right proportions of corporates versus treasuries versus mortgage backs, etc. So what you end up with is this really great opportunity to match an index. And Vanguard published a research note not long ago called it's a balancing act for fixed income funds, balancing between tracking error and transaction costs. And it does a great job of describing how the process of top-down bond index fund implementation is done.
Yeah, interesting. And you mentioned taking a little bit of risk and some of the value added on implementation. Do you have examples of what that might look like?
Sure. One, we want to be very cautious whenever taking risks in a portfolio. We're not going necessarily long or short any individual names from like an active management perspective. But again, we are looking for those asymmetric risk return opportunities. Some of those exist in secondaries in the syndicate market. So a company is issuing new shares. The index is going to make the change at the close of business that day. However, we have an opportunity, being existing shareholders, to purchase those securities in the morning, typically at a 2 to 3% discount from its previous close. Now, the index is buying at the close. We're buying in the morning. We need that discount to hold throughout the day in order to add a little bit of value against where the index would buy it.
What is your view on the labels passive and active as they're applied to investment products?
I think recently a lot of my published work and discussions is trying to remind investors, you want to think about characteristics, not labels. And I think for some reason in the industry, we've gone along this path of this binary categorization of if something is legally and technically an index fund, it's as if it's this uniform, shared, monolithic strategy. And then if you're not that, you're active. And, and a good simple example of this might be, think about two funds. One is technically an index fund or passive, and the other one's an active fund. And I say to you, the active fund has all 500 securities in the S&P 500, and they take very little overweights and underweights across all 500 names. And then the other fund that's technically an index fund is highly sampled or optimized, and it holds 200 securities. Think about what do we all think the characteristics of the risk return, outcome of those two funds might be? Because I would say based upon the characteristics of this example active fund I gave, I bet it's going to end up tracking the index or have a low level of active risk reasonably well vis-a-vis the technical index fund that is highly sampled.
Hmm.
And I know that's like an exaggerated example, but it's one of my better ways of trying to illustrate why I wish we would look past the labels a little bit and think along terms of characteristics and objectives.
Yeah, that makes a lot of sense. Can you talk about some of the active decisions that go into creating an index fund that we would usually call passive?
Can we start with that, Andy?
Sure.
Yeah. What's great about nowadays when you think about index construction methodologies is, we can all go online and look at pretty much every index provider's stated methodologies, the way that they build an index. And I think in many ways the starting point rather is saying, like, who makes it into the family, if you will. Let's take U.S. equities, for example. There's a process that is trying to identify, well, what firms should be called a U.S. firm based upon domicile. What's their tax jurisdiction? Where's their headquarters? Where's their primary area of operation? So the first step is even who qualifies. There's other considerations like what's the minimum level of liquidity that a stock should have to be considered. There's a minimum level of investability, and maybe your listeners of the show have, you've addressed the concept of a float adjustment. And then when you think about, CRISP might have their way of doing that, and Russell might have their way of doing it. The first step is kind of those, if you want to call them subjective decisions, to figure out who even makes it into the opportunity set. And then that second level is making the decision, where do I make my cutoff for large versus mid, or mid versus small, or growth versus value? And then, based upon your index provider, you just get, we can call them subjective active decisions to figure out where the family tree gets compartmentalized. Andy, I don't know if you want to add to
No, I
that.
think you hit it right on the head there. Minor differences when it comes to when to include secondaries, whether it's a dollar amount threshold, a float differential, IPOs, some fast track within 5 days, others, in the rebound. So, minor decisions around when to include.
And actually one maybe more obvious difference is something, you look at a provider like CRISP, and they make their inclusions and their cap size cutoffs on a proportion of market cap basis. Somebody like Russell makes it on a discrete count base, and there's probably a big philosophical argument there about what's right or wrong, but in each case, that's that index provider's definition of the market or the relevant submarkets.
Yeah, it's really interesting to think about. Okay, so given on index, whether it's CRISP or Russell or whatever, what is the main objective of a market cap weighted index fund?
I'll cheat a little bit if you don't mind, Ben. I'll go back to the goal of the index itself. The index itself is to represent the investable opportunity set, and I'm pretty sure you've all mentioned some of Gus Sauter's work, ideal index construction. And from Gus's perspective, it was this idea of what reflects the way that active managers actually act in real life. That is the investable opportunity set that is applicable or available to them. And then from the fund's perspective, it is simply to, as best as possible, track the performance of that index with what we might say tight tracking, meaning with little to no risk in terms of achieving that return.
Now, how closely do Vanguard's funds tend to track their benchmark indexes? And as an extension of that, which of the indexes are the most difficult to track?
Yeah, I could take that one. It definitely depends on the index and the ease of accessing the different markets that index is invested in. If you take a highly commoditized product, large cap index like the S&P 500, those products tend to track extremely close. Even a basis point of mistracking over the course of the year could be considered not a great outcome for us as index providers. But if you start going down further in the hardest to track, it would be something like an emerging markets product where maybe access to different markets is difficult, or there's special withholding taxes where tracking the index becomes very difficult.
What are the implications? Like what happens if a fund does have meaningful tracking error?
I would say in a highly commoditized product like the S&P 500, shareholders could look to other products. There's other ones that exist in the market, and if tracking error is one of their major concerns, and you miss track, you could easily see shareholders going to another investment. Again, it's something that is more difficult, like an emerging markets product. I think, again, it's comparing the different products that are out there, trying to make the best decision for you and your portfolio. But ultimately, if you had consistent tracking error and underperformance, I think shareholders would shy away from those products.
And I think what's really critical with this conversation is, again, maybe going back when we were talking about, this binary labeling of active and passive. I think with that in the industry, we've always seemed to focus on single fund issues. And I think in many ways we lose perspective of, well, what does it mean for my portfolio at large? And to me, one of the biggest reasons to use an index fund is the concept of relative performance predictability. It's a fancy term for saying, am I getting the risk return experience that I should be getting? It's important because as investors, we all do our asset allocation. And it could be any asset allocation. It could be super broad, or you could be very specific about, you have a specific allocation to large caps, mid caps, small caps, etc. The index fund investor is saying, I've done all that modeling work. I know the asset allocation that's right for me. I'm going to implement it with index funds if I'm saying to myself, I just want the experience of the large cap space with a high level of predictability of the relative performance. To go active in that way is to say, well, I've done my modeling in the large cap space, for example, but I'm willing to take the risk of perhaps underperforming or incurring larger amounts of tracking error for the potential benefit of outperforming. And so in many ways, this concept of do I want to implement with active or passive it's a personal preference. Do I just want that experience of a high degree of relative performance predictability, or am I willing to incur a little bit of the tracking risk? But again, this is this important idea of sometimes we got to get out of the product by product comparisons and think to ourselves, what does it mean to my portfolio at large?
Yeah, that makes a lot of sense. We like that about index funds too, is you get the market return or the index return, and you're not worried about plus or minus based on active risk. But it's also a great point that some people might look at the data and say, I do want to take the active risk, and that's their choice. It's interesting to think about. Andy, can you talk about the level of complexity involved in the trading happening behind the scenes in an index fund? I think people just kind of take for granted that index funds exist, but I think there's a lot more complexity than people realize.
Yeah, so it can definitely range from very simple to extremely complex depending on the situation. If you just get a little bit of cash flow in on any given day, you could just simply buy futures contracts and equitize that almost immediately without much thought or effort, to ranging from extremely difficult during our quarterly rebalances where we have a significant amount of flow going back and forth. We're netting, we're aggregating, we're trying to predict what will happen to price action. A lot of what we do is try to mitigate impact for the clients. We're not necessarily just going out and blindly putting something on the closing bell because that's our print and that's our benchmark. We want to make sure that our execution is what is best for the clients of the portfolio. And that might mean a couple different strategies. It might mean trading a little bit before. It might mean trading after, using protective orders around the bell to not have as much impact. And it definitely varies by situation, but it can get pretty complex.
How do the portfolio managers and traders work together to implement an index fund? What are the roles of each?
We're very unique, and I don't know anyone else actually does what we do here at Vanguard, but our portfolio managers and traders are one and the same. So the people that are named on the portfolio are the exact same people that are trading on behalf of that fund. We believe that gives our PMs an advantage to really understand why they're trading something, and helps them in that execution of how to actually do it. And then they can react much quicker to any type of changing information or change in the market without having to go try to find a PM or a group of portfolio managers to get consensus on.
And then on the fixed income side, obviously the portfolio manager is responsible for the strategy of the fund. And when cash flow comes in, they're going to hand off that cash flow assignment to dedicated traders in a various sector. So for like every dollar that comes in of cash flow, there's a proportion that goes to the treasuries trader, a proportion that goes to the corporates trader, the ABS trader or the structured trader, and the mortgage-backed securities trader. So a little bit of a strategist at the PM level, and then dedicated specialists according to sector when it comes to trading and finding liquidity.
So the PM's deciding who's getting allocated what, and then they're making the trades. So that structure sounds like what I've seen in other fund companies, but it's pretty interesting that in the equity side, the PM and the trader is the same role. I didn't realize that. Makes sense though. If we take a fund like, I don't know, like VTI, like a huge index fund, how many PM/traders are involved with managing a fund like that?
Yeah, so if we take a kind of a bigger step back to give you a sense of kind of the desk here, we manage over $7 trillion on the desk. About $5 trillion of that is domestic, with about $2 trillion international. There's 24 portfolio managers and traders on my team. 5 of those individuals are out in Arizona. They're an extension of the desk, but they also serve as a contingent site in case we lose this office or we get some type of weather or outage. We then have 12 portfolio managers and traders in London, and then 12 portfolio managers and traders in Australia. And we take advantage of a pass-the-trade model. So if an order is generated here, but it needs to be executed in Japan, that order is passed to another Vanguard trader that actually handles that order. And that's true regardless of asset class, whether it's FX, whether it's fixed income, equities. We take pride in that there's always a Vanguard trader portfolio manager that is at the helm of that trade, making sure that execution is done in the way that we expect it to be done. And then getting back to your specific question on VTI, so we have named portfolio managers who are responsible for those funds. However, we do take a team approach when it comes to executing on behalf of the portfolios. So if there was a single index change that was happening in a name, it might not be the actual PMs that are executing that. It would be a team that was responsible for figuring out what the trading strategy is, what the risk is, how to go out and execute that, and then they would get approvals from the appropriate channels on, yeah, this is a strategy, let's go.
Man, wow. Do you guys ever sit back and just think about how insane those numbers are?
To be honest, I don't think I could actually write it on a piece of paper right now if you gave me the opportunity.
I had not realized that you had people all over the world like that. Like I said, the sun never sets on Vanguard. There's always somebody awake and at the helm. I did not know that. That's fascinating.
And I think what's for me, being in a research department, but when I get the chance to go up on the trading floor, it is amazing how everybody treats it like it is their family's money. Like it matters at Vanguard when Andy is up there with his colleagues that they are there to look out for the clients and their retirement money, their vacation money, their tuition, whatever it is. It is real here that people treat, Andy talked about the risks, as an everyday thing, and we take that immensely seriously.
Yeah, an interesting story is I was on the trading desk, this is probably 15 years ago or so. We were transitioning from MSCI to FTSE, and it meant a big trade in Korea because Korea was now going to be considered developed, and it was going from a large weight in the emergings to a smaller weight in the developed. So we had a massive sell of Korean won. Back then, Korean won was standing instruction, so it was a very expensive currency to trade. It was a restricted market, and long story short, I was able to actually go over to Australia, go to Singapore, go to Korea, talk to portfolio managers, traders over there, and we were able to trade the FX ourselves, saving clients significant amount in currency executions. But I think for that one example, there's another 20 where we're constantly going out trying to create better market structure, better trading, more transparency. We work with a lot of exchanges as well on their methodology to try to just enhance the way that they trade, to have better price discovery, more liquidity. Sure, it helps our shareholders, but it actually helps the entire ecosystem as well, and we really do care about that.
Incredible. You led FX before securities trading, right?
I did,
Andy?
yes. Mm-hmm.
Yeah. Yeah, that's a cool story.
Yeah, it was interesting. Probably 20 years ago, FX was somewhat of an afterthought for a lot of portfolio managers. Many of them had it on standing instructions with the custodian banks. We did a little bit of it ourselves, and I was able to come onto the trading desk, and it was assigned to me by one of the PMs who just didn't probably want to do it anymore, and just was able to ask a lot of questions around, why are we doing this? How are we doing this? What are the systems that are out there? How can we do a better job? Which ultimately led to us doing a lot of self-execution using algorithms to break up large orders, which then ultimately led to a creation of an FX desk that is now global. So it was a really cool experience.
That's incredible. How much cost savings or otherwise benefit does Vanguard get from something like that?
Significant. I think the FX market has come a long way. We really pushed for more transparency, timestamps, things like that. But I think from the beginning of time, especially with custodian banks, you could probably read about it in papers, they did not give good executions to clients, especially those clients that weren't paying attention. So the fact that we can take it in-house, we can use algorithms to cut up $1 billion order into thousands of smaller pieces and not necessarily demand liquidity, is really significant for our clients, and something we've probably saved hundreds of millions of dollars on over the years, if not more.
Man, yeah, it's so cool. How much of an index fund's implementation, like we're talking about the portfolio managers and their roles, how much of an index fund's implementation is quantitative, like just rules based, versus based on human judgment from the portfolio manager?
It's probably a good combination of both. I think you can't necessarily rely on either to be really good. If you looked at just quantitative approaches to trading, take any rebalance, for example. There's not a cost analysis model that's going to accurately predict the amount of liquidity that's going to show up on those days. So if you had to trade a name, and let's say you might have had 35 days of average daily volume in that name, and you're going to trade at the close, you're going to break every model out there. It's going to say you're going to have thousands of basis points of impact. But in reality, that's not necessarily what we see. We actually see in some cases a stock that you have buy demand actually falls on those rebalance days because the liquidity has been already predicted by the market, and they're ready to actually offset that. So you definitely can't rely on either, and I would say it's probably about 50-50. Quantitative measures are great in certain situations. We have a TCA team here at Vanguard that really helps us model a lot of our executions. One of the things we've done is we've created algorithmic wheels. So this is where our portfolio managers will use algorithms. Those algorithms will go out into the market and execute. But it was really hard to compare one algo with another algo, especially just using human judgment. But we've been able to quantitatively work with those to identify what the best algos are for different markets. So large cap, small cap, mid cap algorithmic wheels, and really get our execution better.
On the fixed income side, what might be interesting to most is within our fixed income index funds, as it relates to this question, going back to what I had said earlier about, cash flow comes in and the index fund is trying to match systematic broad-based risks of the index. And you can think of a scenario where the portfolio manager might say something like, okay, I need an allocation to 10-year AA rated banks. Because that's the big macro risk factor that I need. And then the traders might say, well, there's 4 bonds available that meet those characteristics. And from the portfolio manager's perspective, he or she is good because it matches the systematic risk factors. The trader said liquidity's pretty good. We can now send it off to credit research and ask our credit research department, any 4 of these, which one do you like best? Which one do you like least? And you've got this really pretty cool combination, I think, that probably most don't realize if there's this active element in managing an index fund, but it also relates to that, quantitative versus human judgment as well.
That's so interesting. So when they're looking at the different options to fill that allocation? Are they looking at what, like expected returns or liquidity? Like what characteristics do they care about?
You pretty much have an intersection of all three. Again, if we think about the portfolio manager as he or she being responsible for what are the broad-based risks I need to sort of fill in the portfolio right now, it's up to the traders to say, well, what liquidity is out and available there if we want to fill that spot with a certain select group of bonds. And it's up to credit research to say, hey, well, given these are the risk characteristics you need, and you tell me these are the list of applicable bonds for which you can find liquidity, I'll tell you based on, credit analysis and relative value in that space, which name I prefer the most and which name I prefer the least.
Man, so interesting. And I imagine listeners will be surprised to hear that level of activeness is going on behind the scenes in index fund implementations. Just so cool.